As you probably know and have seen, the growth stock sector is getting absolutely pummeled at the moment. So I'm going to give you an option for a value stock, pays a dividend king, and for the last 10 years has technically beaten the market. So it could be a great play for you moving forward. Welcome back to the channel, guys. If you are new to the channel, you haven't already subscribed and you don't want to miss a video and you want to see all my new videos coming out, then pop down and just subscribe to the channel now and give it a little like while you're down there if you don't mind. Or of course, wait until you've seen the video, you like my content, and then give it a like at the end, if that makes more sense to you. So I thought I'd do a value stock video. It's a dividend payer as well. You might have seen one of my old videos. I've got 3 different portfolios. One is my main portfolio. One is a growth stock, speculative stock, high risk, see what happens. Don't need the money. If it goes to zero, it doesn't matter. Portfolio. And then my fiance and I share a very small portfolio as well. The growth stocks portfolio, the high risk portfolio, is literally on its knees. Some of the positions are like 85% down. Pharmaceuticals, biopharmaceuticals, Zumedica is one of them. You know, those hype stocks that were being hyped up middle of last year and growing through hype, and then people realized its actual true value was somewhere down here, and I bought up there, it's down there. So growth stocks are on their knees. The tech sector is not doing very well. So I thought I'd get a video out there with a relatively safe play. I'll show you why I think it's a relatively safe play. It's a dividend payer and it's been paying its dividend for a very long time. It's a king. And I know I bang on about index funds and income funds and things that I think are safe. I still think your index funds, your ETFs, your S&P 500 tracking ETFs are still probably the safest option. But if you want to branch away from those and get a little bit more of a yield, only a little bit more, then this option could be a good one for you. There'll be other options as well. There's a little family of dividend king paying stocks that have been paying for years and years and years and are pretty safe bets, but this is just one of them. So I'm gonna have a look at TETrading because it is a strong buy on TETrading at the moment. I'm gonna have a look at Seeking Alpha and show you the dividends and the dividend growth, and throughout I'll give you my view on it and the simplest of views, but just simply taking a step back and looking at the face value of their track record, their past performance, which is not an indication for future performance. I appreciate that, but with the track record that they've got and with the analysts on TETrading giving it a strong buy, as I said, it could be a good option just to add a bit of variety to your portfolio if you're just looking at investing in index funds and things like that. That said, this company is in the S&P 500 and therefore probably forms part of index funds that you might be involved in anyway, but it might be nice to have a little bit on the side as well to get that extra yield as a drip feed into your portfolio. So let's get in there. Let's have a look at the stock on the website, Seeking Alpha and TETrading, and I'll give you my view along the way. Right, let's go super simple. We're starting in the portfolio. Not that we need to, because it's not in the portfolio. I think I was part of it recently, sold out of it for something else. Not the point, still would be bullish on this stock. So let's go into it straight off the bat, and we're gonna go into TETrading, and I've already got it up. So J&J is currently trading at $167. TETrading is a strong buy with 1 hold but 6 buy ratings from the analysts, and the highest price target of 215. The average price target 189, and at 189 as the average price target, it gives us a 13.5% upside. Straight off the bat, we're just going to look at the figures really simply today. 13.5% is more than you get on average from the overall market, the S&P 500. It's certainly more than you get from a bank account. Super easy, super simple. There's not a lot else on TETrading that we can look at without having the premium package, which I would need to upgrade for, and it costs $29 a month. So circa 22 pounds probably a month. And at the moment with what I'm doing, I don't feel like I need that, but would be useful in the future. If you go into stock screener, this is quite interesting because if I was gonna want to screen the stocks by dividend yield, which I probably would do and go very high to get my income funds, you need the premium package for that. You also need the premium package for hedge fund signaling, insider signals and bits and pieces like that. Also price target upside, anything more than 10% really, then you need the premium package for that. So it could be quite interesting if you're scrolling through all these stocks, you know, they'll tell you, Apple won't tell you the smart score and things like that, but strong buy, give the upside 7.3%. Microsoft upside, strong buy 22% as an average price for the analysts. So quite interesting stuff. 22% obviously massively market beating figures. Google class A and class B, C shares, huge upside. Amazon huge upside, strong buy. These are all tech sectors that are probably taking a pummeling at the moment, but with massive upsides for the next 12 months. But anyway, I digress. TETrank's really great website. If you want to know all of that and you want to screen all the stocks by this and find these little known stocks that obviously have got huge upside potential, then you can get the premium package and have a look at that. I just haven't because I haven't needed to. But Johnson & Johnson, first things first, we're in the summary page here of Seeking Alpha. It's got a P ratio of 17, which isn't bad at all. The main thing for me, from my point of view, 2.5% dividend yield, which is on the low side for me, in my way of investing at the moment, but beats most index funds, most index fund trackers, most ETFs that you'd be wanting to get into that cover the overall market. They're typically 1%, 1.5% maybe. But for me, we'll have a quick look at just the overall graph of how it's performed in the last few years. And as a value stock, as something that should give you good returns and a pretty much guaranteed income. We'll look at that in a second. Johnson & Johnson, the likes of Johnson & Johnson in the same family as your Procter & Gamble's and things like that are a very good option. Let's look at the return first because we're on this page anyway. So this year so far, in the last year, only 4%. Year to date, it's actually down 2.3%. But in the last 5 years, it's returned 45%. And in the last 10 years, if we look at that, which gives you a broader market, 10 years worth, not a year, had a bad year, had a good year, 2 years, had a good couple of years. In 10 years, it's returned 156. News makes no difference. So you're looking at 15.5% return on the market as a whole, which again is market beating, has been for the last 10 years, overall market beating. And again, I reiterate, much better than having your money in a bank account. The dividends are obviously something I'm very interested in. So 2.54%. It has a payout ratio currently of 43%, which means it's only allocating 43% of its profits to disbursement. The other 56.7 or 69% is being reallocated back into the company, reinvesting into the company, potential acquisitions, all bits and pieces like that. So a 43% payout ratio is very safe. It's suggested that 60% is a sweet spot. Anything below that is looking really good. And it's grown its dividend for the last 5 years, or the 5-year growth rate, should I say, 5.87%, just on the dividend yield as well as market growth. This is the key point for me, and this is why I think that something like this is such a safe bet, because a company like Johnson & Johnson is so big and owns so many other companies. It's so diverse, it's very innovative, it's a household name. People are never going to stop using their products and things. It's been growing its dividend yield for 59 years. Why should a company like Johnson & Johnson suddenly stop paying a yield, suddenly stop paying a dividend, suddenly stop distributing their disbursements to their shareholders? They don't need to, they wouldn't want to break this record, certainly, and they're well set up for it with only a 43% payout ratio. So there's nothing here that suggests that they're ever going to stop paying their dividend, which means it's a very safe, in my view, and I'm not suggesting you put all your money into this, but it's a very safe form of income and much better than putting your money into the bank account if they're going to continue returning good money and potentially market beating money, plus your cash flow in the form of dividends, which can be reinvested. All in all, it's just potentially a very good way to go to put it alongside your portfolio of ETFs and index tracking ETFs and things like that. So if we stick with Seeking Alpha and we go on financials and we just simply look at this first thing, we're not going to go through the rest of it, and I'll be completely honest, looking through balance sheets and financial statements and income statements, a lot of it I don't fully understand, but I know probably just enough. So the first thing I like to look at is revenues. I like seeing that year after year, your revenue is on the increase, which is nice. And the last trailing 12 months, we've had the highest amount of revenue, certainly in the last 5 years, which is nice to see, 4 or 5 years. Another metric that some people like to look at is earnings before interest, tax, depreciation, amortization. So this EBITDA, essentially is net income, but with interest, tax, depreciation and amortization kind of added back in. And a good metric for a company like this, it takes into account depreciation of equipment. Obviously something like Johnson & Johnson's going to have factories and things like that. So it's net income plus a few bits added back in, and it's a very good metric as well as things like your PE ratio, your assets minus your liabilities and things like that. This is just a good overall metric. We can have a look at this, and the figures are pretty stable, and trailing 12 months is probably the best it's been. So the company as a whole, it looks like it's in a very strong position. I think probably because of the industry it's in and everything going on in the world, it's just in a very good position, which is probably why on TipRanks it's been given this upside of 13.66%. So I said, have a look into this yourself. This is an option for you. You might like the look of Johnson & Johnson to add into your portfolio for that kind of safe bet. Not a growth stock. It's not going to jump in price by 200%. It's a value play. It pays a dividend, has done for 59 years. I imagine will continue to, and just could be a good option for the portfolio alongside other bits and pieces that you might have. You want to diversify your portfolio, but Johnson & Johnson can certainly play a key part in any decent portfolio. So that was a super simple roundup of this stock. Obviously Johnson & Johnson is a king, along with the likes of Procter & Gamble, and they're in a very nice little family of dividend payers that are pretty safe bets all in all. And of course, they've beaten the market in the last 10 years, certainly. So a good way to go all around. So just wanted to get a value stock out there. Let me know in the comments below what you think of Johnson & Johnson, whether you're in Johnson & Johnson or Procter & Gamble, or what dividend king you might be involved in, or an aristocrat. I've still got the likes of AT&T in my portfolio, who's still paying a good yield and are an aristocrat at the moment. So let me know down below what other stocks and companies you're involved in, as well as maybe ETFs and things like that. Let me know how your growth portfolio or tech portfolio is doing, if you've still got one, and if it is doing well, let me know. And if you enjoyed the video, as always, give it a like, as it helps push this content out to more people, and subscribe to the channel if you haven't already and you've enjoyed it and you'd like to see some more from me. That'll be it from me until next week. Catch you guys in the next one. See you later.